Kia ora everyone, welcome back to our next edition of Econ Talks. Gareth, there's been a huge amount of media attention about the Reserve Bank in recent times. Of course, a lot of conversations coming through from former chairman of the Reserve Bank, former governors rather of the Reserve Bank, all starting to have a conversation about what's happened over the last 2.5 years when it comes to quite a topsy-turvy, very fast-paced period of monetary policy and certainly some unorthodox policies being implemented. I guess, one question that I continue to have in the monetary policy space is that we did have to move quickly during COVID-19, during those early stages of the pandemic. But realistically, given how much inflation has evolved and how bad our various models got at the start, I'm not confident, though, that we've actually unpacked how New Zealand or other reserve banks around the world might actually respond differently if we were to encounter COVID-19 2.0. In fact, expectations realistically in my head suggest that the Reserve Bank would probably do the exact same thing. The Reserve Bank Governor, Adrian Orr, has said a number of times that there are no regrets to how we've gone about the process, even though there are billions of dollars worth of losses from the large-scale asset program and similar. With all of these criticisms, with all of these challenges, with all of that uncertainty over how we'd respond, I mean, where is the Reserve Bank sitting at the moment? How is that conversation playing out?
Yeah, I think there's two parts to answering that question. One is recognizing that back in 2020, when COVID came and everybody was talking about unprecedented things every second sentence that came out, we looked at it and we didn't know what was going on. The models weren't working, and everybody was on the same page that the economy was going to hell in a handbasket. And so you can't quibble with the sort of immediate steps that the Reserve Bank took at that time. Okay, so we want to be a little bit careful about having too much hindsight. Having said that, you get to the end of 2020 and they were implementing the funding for lending program, and you looked at the economy at that stage, and yes, there were still downside risks. Yes, we still had concerns about where the economy might go to, but you wondered whether piling more stimulus on top of what had already been done was necessary, given the good economic indicators that have been coming through the course of that year. And then we get through to 2021, and yes, we had a lockdown in August, and that sort of stopped the Reserve Bank potentially from starting to raise interest rates quite as early as they might have. But then they took a very, very soft path after that in terms of raising interest rates through October, November, even through into February of this year. And so quite slow to react to what was quite clearly an increasing inflation problem that was spreading through. So some of it we can look back and go, yeah, they got it wrong, but I don't want to be overly critical about that. It's a good question you raise about, what would they do differently next time? And the fact that even as recently as I think it was April this year, Adrian Orr was going, take a breath, she'll be right. We've got things kind of under control, and inflation will sort itself out. And you feel that was a little bit sort of naive or blind to the problems that were coming through. And there's been some good points made around, would we go down the quantitative easing path, or should we go down that quantitative easing path again? If fiscal policy is responding to the pandemic as it did, arguably very appropriately, certainly very immediately back in 2020, do you need to be piling a whole lot of monetary stimulus on top of that? And the answer probably is not the same, certainly not what we saw previously. And yet the Reserve Bank at this stage, they've said, oh yes, we got it a bit wrong, but there's no real clear indications actually of what the lessons they think they should be learning are. And I'm quite disappointed. I think that there's been all this criticism and the bank is still fairly I guess blasé about the job that they've done, and saying, yeah, well, we did our best. Yes, okay, maybe you did, but can you do better next time? We've still got inflation running at 7.3%, and the question is, where does it go to from here, and what is the appropriate response from the bank given the hole they've got themselves into?
Absolutely. And I think, one important conversation that we've got to have here is recognizing that previously, a lot of the thinking was that fiscal policy doesn't respond particularly quickly. Your automatic stabilizers, your benefit supports and similar take a while to flow through, and therefore monetary policy was seen as a quicker mover, at least on the downside. The likes of the wage subsidy and the immediate support provided by government sort of flips that idea on its head. And so again, I think we've got to think through how our responses to crises and shocks come through. But also when we look at that, we know that monetary policy, particularly on the upside, takes anywhere from sort of 12 to 18 months to really start coming through. And I think that the challenge, right, is that when we had 3.3% inflation recorded in the June 2021 quarter, it was clear by that point that inflation was starting to get some runs on the board. And that's why we took what was, I hate to say it, a bit of an unprecedented position come August, where we were saying, look, the Reserve Bank should probably be increasing the official cash rate by 50 basis points. And we said that consistently from August all the way through to April 2022, when the Reserve Bank actually started to move in those bigger hits. And so I think, there is a lot of conversation there over if we could see that there was that building pressure in the economy, we did need to move a lot faster, and I don't think we have. And because of that, like you say, inflation now running at 7.3%, exactly on our pick for the June 2022 quarter. And I guess what sort of got us with that result is that the pricing pressures that we knew were going to be hot came in exactly as expected. We knew that fuel prices were going to be up. We knew that food prices, rents, building costs were all going to be expensive. So that came in as expected. What surprised us was the breadth of other inflationary pressures that are starting to spread out. Some of the changes around the likes of hospital fees, pet insurance, and, a huge range of quite odd little things. But you do get the feeling that that spread of inflation has been coming forward. In fact, for the first time since back around the inflationary spike of 2008 or so, you saw that 66% of all products that Stats NZ measures increased in price. That's the largest spread of price increases seen in a decade. So there is that deepening of inflationary pressures, and that's before all of the wage increases that have been coming through start to flow through into broader and more persistent levels of domestic inflation. So we do see quite a lot of pressure, quite a lot of heat coming forward. We are, I guess, expecting, I think a little bit hoping that inflation doesn't get all that much worse from that 7.3% annual rate. But realistically, given where things are, given the breadth of that inflation, it does sort of fuel our expectations that inflation might well remain at that persistently higher level for a lot longer. I mean, expectations at the moment are still that inflation could be at 6% by the end of the year, still above 3% coming into 2025. So a huge amount of pressure realistically on the Reserve Bank to continue to take action on inflation. What are the next steps, Gareth, when it comes to the Reserve Bank trying to combat inflation, given that they're still realistically behind the eight ball?
Yeah, well, there's still more 50 basis point rises to come, one or two more through the course of this year. So yeah, that's taking the OCR to at least 3.5% by the end of the year. And in fact, we've been talking about the potential for a 75 basis point rise. We've seen, of course, increases of that magnitude occurring overseas, particularly with the Federal Reserve in America. And so there is a lot of pressure there. I think the difficulty for the Reserve Bank at the moment now is that when we look at economic growth, the economic growth outlook going forward from here, it is quite soft. Yes, we're going to have a recovery in tourism, and that will help to mitigate the slowdown a bit. But generally speaking, if you're a domestically focused business over the next 12 to 18 months, you're going to be striking some more difficult conditions. Now, normally the Reserve Bank would then start to be thinking about cutting interest rates and just providing a bit of a cushion for the economy, but that is entirely inappropriate at the moment, given where inflation is and the fact that they need to get those inflation expectations, the pricing and cost behaviour back under control. They've lost a lot of credibility over the last 2 years, and you compare it to 7 or 8 years ago when nobody wants to put their prices up at that stage. Now everybody is doing it, and everybody knows that everybody else is doing it and is not afraid to follow suit as well. So there are real risks there that, in fact, if anything, interest rates need to go higher and stamp on that inflation, but also ultimately stamp on that economic growth and some of that demand that has been across the economy. Yes, we need to rein it in, but of course, because they've been slow on the upside, the risk is that they actually overcook things on the other side just to get things back under control. And then, of course, the downturn, the dreaded recessionary word, starts to come into play, and you're exacerbating the economic cycle. And I think that's the ultimate insult for the Reserve Bank, really. They're charged with trying to maintain stability across the economy, not just price stability, but of course, making sure they're not exacerbating that cycle. Arguably, you'd have to say over the last last 2 years and potentially over the next 1 to 2 years, in fact, their policies now are going to be exacerbating the ups and downs. And that's really uncomfortable for everyone, particularly in the business space, but also for households as those interest rates get ratcheted up as well.
Absolutely. And look, that's the crux of the matter, isn't it? That realistically, when you look at the pathway for the official cash rate and mortgage rates and interest rates generally, you'd almost say, look, if consumer and household confidence and business confidence has tanked so bad as it has, this would generally be the time where you'd say, actually, we can probably slow up because we don't want to turn down the temperature on the economy all that much. But the amount of pricing pressure out there and the risk that if you don't forcefully bring those prices down and bring people's expectations that they're going to be hit hard by those higher interest rates coming through, then you might well not see that pricing response come through as quickly. And that, I think, is the biggest challenge the Reserve Bank's got to do, is that it's got to actually ignore the potential realistically for a recession, for those changes in economic activity, and really strongly jawbone the market, jawbone businesses into thinking, actually, heck, I need to calm down when it comes to price increases because I'm going to get hit with those higher costs quite quickly. And so realistically, that's, I think, where that conversation between maybe a 75 rather than a 50 basis point comes forward. Because if you know where the end point is, there is, I think, an argument for doing it quicker, for putting a lot more of a shock into the system and really sort of scaring, businesses into that much stronger response quicker, and then actually being able to possibly let up a bit faster. But again, the cat seems to be a little bit out of the bag already. Inflation running at a 32-year high, pricing expectations still remaining at large levels, and those expectations around prices becoming unanchored. With all of that, we'll continue to assess what the Reserve Bank does, where some of those expectations move, and probably importantly, what future actions we might have to see from the Reserve Bank on one of our future editions of Econ Talks.